In this video, I will be talking about consolidation after acquisition, focusing on year 2 and beyond when the parent company has elected to use the equity method to account for its investment. In the last video, we left off after the first consolidated year end. In this video, we will consider the second consolidated year end and beyond. After the first year end, the parent company will continue to use the cost or equity method to adjust the value of their investment in S on their general ledger. When we get to the second year end, and every year thereafter, we will have one additional challenge that we didn't have in the first year. In the first year, any adjustments to the income statement accounts could be made on the income statement. In the second year, we have to adjust for current year income that can be made on the income statement, but also have to adjust for prior year income that need to be made through retained earnings. For the equity method, we will use the same 5 steps we learned last lecture, but the numbers will change on us to reflect the changes in retained earnings due to the prior year's income. For the cost method, we will need to add our entry to establish reciprocity, but we'll cover that in a future lecture when we get to an example with the cost method. For now, let's continue our equity method example from the previous video. In this example, we will be continuing the scenario from the previous video, using the same company, same acquisition, but we've just moved 1 year farther into the future. So we are now at the end of 2015, whereas in the last video we were at the end of 2014. They've given us a little bit more information, told us that during 2015, sales company earned $190,000 in net income and declared and paid a $50,000 dividend. Just below that information, we have our computation and allocation of differences schedule. If you're following along in your Excel, this is pre-populated from last time because remember, our computation and allocation of differences schedule is prepared on the date of acquisition. So since we already did it for this problem, we don't need to do it again. It's not going to change. We just want to be able to refer back to it. Okay, so like last time, they want us to prepare the investment-related entries on PERT Company's books for 2015. So again, we need to remember that PERT Company is using the equity method. And under the equity method, we are going to record a journal entry when our subsidiary company makes income or pays a dividend. In this case, our subsidiary did both. So our subsidiary made positive income, so that's going to increase the value of our investment. So we're going to debit investment in S to increase the value of our investment account. The subsidiary made $190,000. Our ownership percentage is 85%. So we're going to increase our investment in S by 85% of the earnings for the year, which is $161,500. Our credit, again, remember, is going to be investment income, but this book calls it equity in S income. So I'm going to call it that to be consistent, but that is investment income. Then our subsidiary also paid some dividends. So we get a check in the mail. So we're going to increase our cash account. The amount of that check is going to be our share, or 85% of the dividend that they declared and paid, which is $50,000. So the remainder of that $50,000 went to these non-controlling shareholders. Again, because we're using the equity method, this is going to decrease our investment in S. It's treated as a return of our investment. Okay, and that's all we would record on our parents' books. So again, remember, our parent company is in yellow. Now we're going to switch to our work paper entries, and those are going to be in orange. So it's important to remember our starting point here is we've already taken our parent general ledger and added to it our subsidiary general ledger. Now we need to make some entries that adjust that starting point. So first thing is eliminating intercompany transactions. We still don't have any of those, but again, I just want you to remember if we did, we would need to do something about it. Number 2, eliminate any current year subsidiary income recorded by the parent. And so this is where it's helpful that they had us write out the entries that were on the parent's books because it lets us see what income we recorded. So we recorded an increase to investment income, investment in S, and also an increase to investment income. Now, we don't want either of those on our consolidated balance sheet, so we're going to just do the opposite of this entry for financial statement reporting purposes. So we're going to temporarily cancel out that entry we just made. So that's going to be a debit to equity in S income and a credit to investment in S for the full amount. Okay, then when we get to our dividends, again, we want to cancel out the effect it had on investment in S. So we're going to debit investment in S for $42,500. But the cash we said last time, we're fine with, because whether we consolidate it from our parent's general ledger or consolidate it from our subsidiary's general ledger, it doesn't really matter. If we undo it here, we're just sending it back to our subsidiary general ledger or taking it off entirely, which doesn't make any sense because it is our cash. So what we need to do is we need to figure out a different credit. And so last time what we said is that this was a special intercompany transaction where what we needed to undo was the subsidiary's issuance of these dividends in the first place, because you can't pay dividends to yourself. So this is going to be dividends declared by our subsidiary. And if you need a little bit more help with the logic on that one, head back to the previous video and rewatch what we talked about there. So we've undone these two entries, and now we're going to do our two entries that we're more familiar with again. But this is where the numbers are going to start changing on us. So we're going to, again, as we did last time, do all of the account names first, and then we're going to come back and do the amounts. So we know that we still have investment in S that we need to get rid of. And that's an asset account, so we're going to credit investment in S. We also know that we have subsidiary equity accounts that we need to get rid of. All of those subsidiary equity accounts had a normal balance, so we're going to expect those to still have a normal balance. We're going to do common stock of our subsidiary, other contributed capital of our subsidiary. And remember, this was new last time. We need to specify 1/1 retained earnings of our subsidiary. Then if we own anything less than 100%, we know we're going to need to establish a non-controlling interest. Given we have an 85% interest, we're going to need to create that non-controlling interest account, and that is an equity account, so we're going to create it using a credit. And then finally, we have our difference between implied and book, which was positive when we initially calculated it, which means it will be a debit in this entry. Okay, so let's talk about the things we know won't change. Our difference between implied and book is calculated on the date of acquisition, so that will not change. That will always be whatever it is on our computation and allocation of differences schedule. Also, because our book is nice to us, this is not necessarily the case in reality, but because our book is nice to us, we won't issue any stock after an acquisition. The subsidiary won't. So our common stock and other contributed capital of the subsidiary will also always match what they did on the date of acquisition. So the amount that needs to be eliminated is whatever is on our computation and allocation of differences schedule. Now here's where it gets a little bit dicey. Retained earnings of our subsidiary necessarily is going to change over time. Unless our subsidiary breaks even every year and never pays dividends, obviously retained earnings is going to have to change. It's going to go up every time they make income, and it's going to go down every time that they pay out dividends. So sometimes they will just give us the new balance of retained earnings. This time we're going to have to calculate it because they didn't give it to us. But we know everything we need to know. So we know that on the date of acquisition, it was $140,000. And now we're trying to figure out how it's changed between then and the beginning of the second year. All right, so that means that there is 1 year's worth of transactions that have taken place. And we already talked about those last class. So if we go back to last year's example, we see that sales company earned $148,000 and paid $50,000 in dividends. So that means that we need to Just gonna redo this. So we need to take our original $140,000 and add to that the $148,000 and subtract from that the $50,000, which gives us a new retained earnings balance as of the beginning of the year we're consolidating that was $238,000. So this is hard because we need to make sure we take into account everything that happened before the beginning of this year, but nothing that happened this year. So our current year income and dividends, we already eliminated up here. So we don't want them in here. Now for the tricky part. We've now made it so that our journal entry won't balance because we've changed this number. Everything else is the same, but we've changed this one. So what we're going to do is we're going to take the increase in this number and we're going to allocate it between investment in S and non-controlling interest using our ownership percentages. Okay, so stick with me here. On our date of acquisition, investment in S was $350,000. We need to increase that by our share, or 85%, of the difference between retained earnings as it appears in our eliminating entry now, so as of the beginning of the current year, and what it was on the date of acquisition, which will be in our computation and allocation of differences schedule. So we're just taking our investment in S from the date of acquisition and adding to it our share of the change in retained earnings from the date of acquisition to the beginning of the current year. Okay, we're going to do the same thing again for non-controlling interest, so bear with me. Non-controlling interest, we're going to take their initial amount, which was $61,765. We're going to add to that their share, which is 15%, of that same change in retained earnings. So retained earnings as it appears in our current eliminating entry minus what it was on the date of acquisition, which can be found in our computation and allocation of differences schedule. And so now our journal entry will balance because we have allocated the increase in this account between these two. All right, then our last step is the easy one. Nothing has changed here. We need to take our difference between implied and book and allocate it to fair value or goodwill. So difference between implied and book. And they told us last time that this was due to a fair value adjustment in land, and so we are going to put it in land. You might be asking yourself, why do we have to do this again? The reason is these are temporary entries. So these are not recorded in the general ledger. So when our starting point is the general ledger of the parent and the general ledger of the subsidiary, nothing we did last year sticks. Nothing gets recorded to those general ledgers. So it's basically, we have this set of entries, we make our adjustments, then we chuck it away. We get 2 new general ledgers next year, and we have to come up with a whole new set of eliminating entries all over again. Obviously, they have similarities, but we have to go through this process every single year. This concludes our lecture on consolidation for year 2 and beyond using the equity method. Don't forget to email questions for our discussion.